Hello students. Unlike the last video clip, this video clip will be discussing about the net sales recognition with a discount being assumed. So journal entry of the transaction is exactly same as the previous exercise, except for some transaction partner. Okay, let me read this. Assume Apple Inc. delivers a truckload of iPhones to AT&T Wireless. Now the AT&T, the business partner to Apple, is very has high credit, has a warehouse in Florida. On the truck are 10,000 iPhone, okay, the same amount, and each of which Apple Inc. sells to AT&T Wireless for $100 per one iPhone on account. So Apple Inc. will allow 210 net 30 discount term, exactly same discount term, based on the past experience. AT&T has met a discount term, so Apple recognized net sales. Okay, so the difference between these two income statements is that we started from the gross sales, assuming that in the previous case with the ABC Wireless, we do not consider this. The ABC Wireless will take this 2% discount by paying accounts receivable within 10 days. But in this case, we have AT&T. AT&T will pay within the 10 days. So we started from the net sales already taking into account 2% discount. So accounts receivable, we should record how much, right? The 2% discount, $100 per one iPhone. How many? 10,000 times 10%, so 98%. So $980,000 accounts receivable, assuming that this AT&T Wireless will pay within 10 days to take advantage of 10% discount. And then credit side, now we started from net sales, considering the sales. So we don't start the gross sales into the income statement of Apple. So 980, exactly same as the accounts receivable. And then based on the matching principle, the cost of goods sold, okay, cost of goods sold, how much was there, right? iPhone was $60. Each iPhone, the $60, okay, times how many? 10,000. And then when we record this expense of the goods, inventory out, when the Apple sold this inventory out, so 600. Then transaction number 2, collection within the discount term. As expected, AT&T fulfills its obligation to pay within the discount period to get the 2% discount. So the cash received, cash collected to Apple, how much is that, right? 980 exactly, because AT&T fulfills its obligation. And then account receivable should be removed, 980. So let's post into the T account of each account. So accounts receivable, 980 should be removed. And then the ending balance of this accounts receivable is 0. Net sales is not the gross sales. Net sales is 980, cost of goods sold 600, and the inventory out when the Apple sold the inventories at 10,000 iPhones. And then cash, $980,000 received. Okay, then let's pass to this account balance onto the balance sheet and income statement. Accounts receivable is 0 on the debit, and then net sales is simple. So 980, cost of goods sold, always expense on the income statement is negative. So the gross profit is 380. And then we don't have any other transaction, so retained earning should be the net income. Then inventory out, when Apple sold, net cash received 980. So we balanced out 980, the total asset and liability plus equity. Okay, This is just a normal transaction starting from net sales, assuming that this business partner, the customers, will pay out within this discounted term to take a discount percentage. So we started from the net sales, just 2% after 2% discount. Okay, then next, as you guys expect, it's totally different situation. Different starting point are the same. So we start from the same transaction. Apple consider the 2% discount, as AT&T usually pay out within 10 days to take the discounted advantage, and then net sales is starting point, and then matching principle, inventory out. But all of a sudden, AT&T could not fulfill its obligation to pay within the discounted period. That means that, okay, they paid just in 30 days. So to 10 net 30, the 2% discount is not applied to this situation. But the Apple already recorded net sales. So how could we deal with this? So in this case, inevitably, we have to use other revenue account. Other revenue account, there you go. You see this other revenue account when the discount forfeited. So we start here the same as, okay, cash. How much we received then? Because the AT&T would have paid 980, but they forfeit. They could not fulfill its obligation within 10 days, but they paid 30 days, right? So they have to pay the full amount. So $1 million, the full payment. But AR, now accounts receivable, how much accounts receivable we have to remove? $1 million? No, it's not $1 million. The accounts receivable, the Apple has had 980, not 1 million. Okay, and then doesn't have any obligation or any right to receive cash. 980. If we put 100, what happened? We'll see the next. I'll show you what happened if we put the 1 million on the accounts receivable on credit. So what is good for the Apple Inc. is that the Apple received $20,000 more. So what is $20,000? How do you record this? Right, this is other revenue. Why do you put other revenue on the credit side? Because revenue on credit, they increase equity. So $20,000 received more. By doing so, we can balance out debit and credit. Okay, so we just post all this, the accounts receivable, then net sales starting point 980, and then cost of goods sold. Okay, on the journal entry and the T account, there's no negative account because we can use the other side, the other account, the part like credit or debit. So there's no minus on the T account and the journal entry, but the balance sheet and income statement can have a negative based on contra account or the expense. Inventory out on the credit, that means inventory out. Cash received 1 million, and then other revenue 20,000. Then let's record. On the balance sheet, accounts receivable balance is 0. The net sales starting point, because the Apple assumed the AT&T will pay out within 10 days. So starting point 980. The cost of goods sold 600,000. So the gross profit is now 380. Inventory out $60,000. Then the cash received is not 980 because the AT&T couldn't pay within 10 days. So cash, the full amount of the sales 1 million without any discount consideration. And then other revenue is additional revenue, but we cannot record the revenue part because we record only the already net sales. So the other revenue part of $20,000. So the gross profit is 400. The gross profit is 380 plus the other revenue 20. So net income is 400. Then this net income should be retained into the retained earnings. So we receive the cash and then receive the $1 million and we recorded the sales, the net sales and other revenue. The sum of these two is 1 million. Okay, so that's it. See you in the next video clip. See you. Bye bye.